Frankfurt, Germany, the European Central Bank will ease the pace of its bond-buying stimulus program, dialing back a measure that has supported the eurozone economy's recovery from a debt crisis that threatened to break up the currency union. The ECB said Thursday it would reduce its bond purchases to €30 billion, $35 billion, per month starting in January, from €60 billion currently. The purchases would continue at least until September 2018. The bank kept some flexibility in its statement, saying that it could increase the purchases if the 19-country eurozone endures a new economic shock. Steady growth has enabled the ECB to look toward phasing out extraordinary stimulus measures in hopes that higher wages will eventually push inflation up from 1.5% to its goal of just under 2%. The withdrawal of the stimulus will have wide-ranging consequences on investors, companies, and governments. One reason the ECB is moving slowly. Eventually, governments may pay more for borrowing and have less to spend, while companies that would not be profitable under normal interest rates may go out of business. But the ECB's low pace in removing the stimulus and raising interest rates means the impact will be slow. So savers with money in conservative holdings such as bank deposits will endure another several years of paltry or non-existent returns. The bond purchases were started in March 2015 amid fears that lower negative inflation would become chronic, a trap known as deflation that can hurt the economy and be difficult to escape. Inflation has responded only slowly. The ECB must think about ending the program, in part because it could run out of eligible government and corporate bonds to purchase. The program has also been opposed by a minority of stimulus skeptics on the governing council. The bank says it has room to end the stimulus as the economy continues to grow faster than expected. The 19 countries that share the euro currency saw their combined economy grow 2.3% in the second quarter compared with the same quarter the year before. The crisis over high debt in countries like Italy, Greece, Spain, Portugal, Ireland, and Cyprus has eased, though levels remain high in Italy and Greece still faces painful unemployment rates and a shrunken economy, despite getting 3 rounds of bailout loans. Under its stimulus program, the ECB buys bonds from banks, adding newly created money to the reserve accounts the banks are required to have at the ECB. That is the pipeline the ECB uses to push that new money into the hands of banks. Ultimately, the effect should be to increase the availability of credit, drive down longer-term interest rates, and increase inflation. The bond purchases have driven down bond market borrowing rates, with the result that the German 10-year bond yields 0.47%. By comparison, the equivalent U.S. Treasuries yield around 2.4%. But inflation has been slower to respond. The ECB foresees only 1.5% for 2019, still short of its goal.